Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax updates to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. The Pillar 2 engine from PwC is a game changer for Pillar 2 modeling, provision, and compliance calculations. Built on a graph system utilizing over 20 years of international tax technology, this centralized rules engine is built by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as both a service and license. On this week's episode of Cross-Border Tax Talks, we're back in PwC's Policy on Demand studio in Washington, D.C., where I'm excited to have Phil Ramstetter back on the podcast. Phil is an international tax partner at PwC and former tax policy consultant at Business at OECD, formerly known as BIAC. Phil, welcome back to the podcast.
Thanks for having me.
So this is your first recording here in our DC studio. I'm excited to have you here. But before we get into some of the material, Phil, I wanted to congratulate you on your recent wedding. You just returned from your honeymoon in Venice, Italy. Do you have any travel tips, memorable things, anything that you would recommend for listeners if they have the opportunity to head to Venice?
Yeah, this is nice. I think I went like a decade without any significant life updates. In the last couple of podcasts, I had a baby, got married.
We're giving everybody the
nice.
information. Yeah.
So in Venice, I would say my wife, Jen, I think really enjoyed the gondola ride. It's very romantic and all of that. My favorite part of it, I think, was like the Doge Palace over by St. Mark's Square. Just the history of Venice was really incredible, of like the kind of early moving of democracy and kind of how they did things. So I found that the most interesting.
It's probably been 30. I went when I was a backpacker back in university and have not been back, but it's high on the list for me and Kelly, who I just celebrated my 19th year anniversary.
Time flies.
We want to get back there. Time does fly indeed.
Well, the good thing is that I think it's like 1,000 years old, so it's probably the same as it was.
Yeah, it's as long as it doesn't, as long as that water doesn't rise too high. Hopefully, we'll make it back there. All right, so let's dive into Pillar 2, one of my favorite topics. And before we get into the latest administrative guidance that came out in June 2024, can you provide listeners just a brief background and some context? I think this is our fourth administrative guidance. Yeah. How did we get here?
Yeah, definitely. So the OECD put out what we refer to as the model rules for Pillar 2 in December of 2021. So quite a bit of time has passed since then. In March of 2022, they released the commentary, so effectively additional commentary guidance to the model rules. Since then, they've now released the fourth package of administrative guidance, and effectively the way the administrative guidance works is that it's effectively more detailed commentary. So they'll incorporate all of the administrative guidance effectively into a revised commentary document. And the way that those rules are meant to operate is it's effectively providing additional clarity or detail on how the model rules operate. But as we'll get into today, some of that stuff is, I'll call it interpretation and clarity on how the rules operate. In other cases, I think some of the administrative guidance is to some degree just a new rule that they're effectively adding by adding it to the commentary.
And I will remind listeners, and regular listeners probably don't need to be reminded that, again, the OECD is just providing a structure of rules that still have to be enacted by every jurisdiction.
Yeah, exactly. And like we'll get into it in a minute with just how detailed this guidance is. But publicly, the OECD and a lot of the member states of the inclusive framework have effectively said, like, hold on, guys, like we got to pump the brakes on some of this guidance. We're having a really difficult time digesting what's being put out and being able to take that and incorporating it into our local statutes. So it is the kind of first step of that actual implementation process where the countries actually take it and domestically enact it.
Exactly, and we've got just 36 countries that are enacting Pillar 2 in some form or fashion this year. This administrative guidance becomes a challenge for them, as well as for the 50 or so that the OECD has said will bring rules in next year. Each of those 36 countries will have to figure out a way how they incorporate, or if they incorporate, this administrative guidance. And I think, as we dive into some of the specifics, that it feels to me a bit that this latest administrative guidance took a turn of just very, very specific rules. And it felt, as a U.S. practitioner, this felt very much like a reg package with some of these details.
Completely agree. I mean, just the way that it's framed up with effectively they have some commentary and then actual changes to the commentary. And it reads almost like a US reg package where effectively you have preamble, background, followed by the rule.
Right.
And you can see just a lot of the approaches we'll get into with the various steps and the mechanical approaches. It reads a lot like some of our GILTI regulations
Right.
and some of the things that we've had on the US side.
And this is by far most detailed guidance to date and very mechanical rules. Yep. And again, I think as US practitioners, something maybe we're a little bit more familiar with and used to. And I think from some of the discussions that I've had with taxpayers and colleagues around the globe that this, I think, took some by surprise or just given the detailed nature of this. So let's start then with the first section of the administrative guidance, which is a quote unquote simplification of the 5-year deferred tax loss recapture rule. But I think it's worth level setting on the model rules first before getting into the guidance on what the 5-year rule requires. So maybe a little policy and background on this particular provision.
Definitely. So as most listeners will know, generally Pillar 2 calculates an ETR by taking book income and then book deferred and current tax. However, when you're taking into account your covered taxes, so the deferred and current, there are certain adjustments that are required to those tax numbers. One of which is what we call the 5-year DTL rule or the DTL recapture rule. This guidance was specifically on that item. And basically what the model rules say is that if you recognize a deferred tax liability and the deferred tax liability does not reverse or be paid within the 5-year period thereafter, you effectively don't get credit for that tax within your covered taxes. So the policy behind it from the OECD's perspective was they didn't want to give taxpayers like a credit for a tax if the tax was never really going to be paid. So I think that's some of the fear that was baked into the rule itself, albeit in practice with us working with multinationals that care a lot about their rate. They're not simply booking DTLs to book DTLs, right? Like there is an actual ETR charge as a consequence. So as you're working through the rule, the difficulty of it is that you're gonna have a charge in the books either way if you have this DTL. This rule effectively governs us whether you can take it into account for purposes of Pillar 2.
Yeah, and the comments that we have heard and have been publicly stated by many with respect to this 5-year DTL recapture rule is that most taxpayers, I'm not aware, frankly, of any taxpayers actually keep track of whether a DTL reverses in 5 years. And so this was just many of a long list of just kind of additional compliance burdens to be able to keep track of and attributes to manage that are really unique to Pillar 2 and not something that really any public company is typically tracking historically.
Exactly, and like we can get into the guidance probably now just real quickly, but the idea of the guidance is a quote simplification as to how you would track how these DTLs are recognized and how the DTLs reverse. And basically what the OECD acknowledged in the guidance is that the rule as written would effectively require a tracking of the DTL on an asset by asset or a liability by liability basis. So if you think you have a massive balance sheet account or GL account that has thousands of assets and liabilities within it, technically this tracking would need to be done on each of those individual items. The guidance effectively provides that in certain cases, they're going to let you aggregate those deferreds within, in one case, within a GL account, or in certain instances, multiple GL accounts that build into the same balance sheet account. But the general idea is, I think, the OECD acknowledging that taxpayers just are unable to do the tracking on as granular of a basis as the model rules suggest. So they're going to let it tier up at a more aggregate level and do the tracking that way.
And there are a number of exclusions as well.
Correct. So generally there's certain items that are just excluded from the ability to aggregate. So one is like indefinite life intangibles, long-lived intangibles, or intercompany payables and receivables. So kind of those three are just kicked out of the ability to aggregate with others, which to some degree is unhelpful because I think some of those cases are where we see a lot of the problems with the 5-year rule, which is most likely why they excluded it from being able to be aggregated.
Right.
In addition to that, there's certain other restrictions on what can be aggregated if they have, quote, like swinging accounts. So accounts that go from DTA or DTA, or accounts that generally kind of build a DTA account. So you basically, as a first step, need to figure out where the various GL accounts would be basketed in kind of this bucket of, yes, it can be included, no, it can't be included. Then you can determine at what level you can aggregate, and then you need to work through the rules as to whether you can do effectively last in, first out tracking or first in, first out tracking. And there's kind of parameters around that as to.
Yeah, so talk about that, because that was one of the
Yeah.
big issues is what ordering as we think about these DTLs. Is it FIFO, is it LIFO?
So generally taxpayers can use FIFO, so first in, first out, which is generally going to be a better answer with how you would track the reversal period. You can use FIFO in certain cases. It's basically if you effectively have a single GL account, you can use FIFO. If you have a GL account that effectively includes intangibles that have a similar recovery period, or the third basket, which I'm not actually sure what it means, is that you can effectively prove that the approach that you're taking with the aggregating would have come to the same result as if you had done it on an asset by asset or liability by liability basis. But big picture is, assuming you can meet those requirements, then you can do effectively first in, first out. Then you track on a yearly basis what the kind of reversal period is. So they come out with all these defined terms. I kind of wrote them down so I could come up with it of unjustified balance, outstanding balance, maximum justifiable amount, kind of all these new defined terms. But the general idea would be effectively, you're going to build kind of what your DTL amount is, what amount of DTL that reverses, and then the net amount, if there is any remaining, is going to be a bad DTL amount effectively for purposes of the rules. So, but effectively you aggregate these rules across and then within the 5-year period kind of track as it reverses.
Yeah, my takeaways from this particular provision is, I guess, first, that the term simplification felt a little generous, given the complexity associated with these rules. And, but I think from a positive perspective, without being overly critical, it's hard to, I get it, it's hard to simplify this stuff. These are complicated concepts.
Yeah, because they're trying to basically maintain, I'll call it the integrity of the rule while providing the simplification. So I think those two things pulling and pushing at each other makes it difficult.
And I think from much of the commentary and discussions with taxpayers, that frankly the rules with respect to aggregation were very consistent with the approach that I think taxpayers are going to take, if for no other reason that is the only way they can actually get the data.
Exactly. Like I think it to some degree is just an acknowledgement of this is probably what they were going to do anyway, so we're going to bless it as okay. Because as your point, like they just don't have the data to go to the asset by asset or liability by liability level. So there's going to be some level of reasonable simplification taken. Now we just have more explicit rules how to simplify and kind of follow the tracking.
Which explicit rules are always helpful for taxpayers, for advisors, for those of us that are building calculation engines, and so that's why, and we'll cover this as we get to the end, but frankly, this detailed guidance, as much and as challenge it is for the implementing jurisdictions to actually process and get in, is frankly something that taxpayers and advisors need to be able to understand how to actually comply with these rules.
Yep.
So let's move to the divergences from GLOBE and accounting carrying values. This is guidance that we've been awaiting since February 2023 guidance was released. What does this broadly cover, Phil, and does it provide any helpful clarity?
Thanks, Doug. Yeah, so I would basically bucket the guidance into 4 different buckets. So I'll hit the first 3 first, and then we can get into the last bucket, which I think is generally going to be the most impactful. So the first, I would say, is really a clarification of what taxpayers and we as advisors were probably already doing, which is in certain cases, there's required GLOBE adjustments that effectively move GLOBE, the Pillar 2 calc, closer to what local tax is. And as a consequence, by moving GLOBE to tax, there's an elimination of the related deferred that may otherwise be in the system. So an example of that would be the pension adjustment. So generally, there's going to be a pension accrual that is in, for US GAAP taxpayers, the US GAAP accounts. But then there's an actual cash contribution that may be made to the pension fund. The way the rules work for pension is effectively you back out the accrual and you take the contribution amount. So as a consequence, now GLOBE equals tax. And basically what the guidance says is that you need to recompute your deferred tax on that same basis. And if there is a deferred, it effectively gets eliminated. That's because there is no longer a timing difference for GLOBE purposes because GLOBE equals tax. So there's guidance that covers that, realization method election, stock-based compensation election, and purchase price adjustment. So those are kind of helpful areas of it, I would say, clarifying most likely what taxpayers are already doing. The next section would be on one of the transition rules. So in Article 9.1.3, it's effectively a transition rule where you have a sale or transfer of assets from one constituent entity in the group to another constituent entity in the group. the February admin guidance from last year effectively provided relief to that transition rule, because the transition rule otherwise applies to say you don't get basis or you don't get a deferred tax asset at the acquiring entity. And they basically provide that if tax is paid on that transfer, you do get the DTA or the basis at the acquiring entity. The three clarifications they make there is, one, the acquiring entity does not take into account the DTA that's booked under that rule for purposes of its covered taxes. Two, effectively, the deferred is not limited to what is otherwise in the GAAP book. So let's say Germany sold IP to Ireland and we have a 12.5% DTA booked in Ireland. If we paid tax of more than 15 in Germany on that transfer, we would actually get a 15% deferred for purposes of Pillar 2 in Ireland versus being limited to the 12.5. And then the third clarification was other taxes that are paid. So think of like a US Subpart F tax or US GILTI tax. Those taxes can also be taken into account for purposes of that guidance when freeing up what other basis or DTA we'd get at the acquiring company. So I think those, and then the third of the kind of quick hit buckets of the guidance would be a general confirmation that most of the GLOBE articles do not apply until you're within the Pillar 2 rules. Mm-hmm. So we effectively have two separate systems. We have the transition period and the transition period rules, and then when you're within Pillar 2, the Pillar 2 rules kind of as outlined, which is really difficult for clients because, and I think we've covered this before with the safe harbors, but effectively if a country meets the safe harbor, the transition period continues through the period it meets the safe harbor. So if you're looking at the foreign group, you may have half of your entities that are in the safe harbor, half of them that aren't. So some are going to be in Pillar 2, some are not going to be in Pillar 2, and going to need to track kind of how these rules operate accordingly.
So a number of these clarifications seem helpful, but what about the fourth bucket, which I assume you're going to, is the guidance on transactions that are within the GLOBE rules?
Yes. So if you're within the GLOBE rules and you have the same transaction before where we have Germany sells IP to Ireland. If Germany is no longer in the safe harbor and we're within the Pillar 2 rules at the transferor level, basically what the rules provide is that instead of getting a deferred tax asset, which for US GAAP taxpayers would generally be the answer, for GLOBE purposes, we're going to say we get GLOBE basis at the acquiring company. So this was an unknown question that was kind of punted on by the OECD in the February admin guidance from last year as to what to do at the acquiring company. They said the seller recognizes gain and we're going to do something that avoids double tax at the acquiring entity. This is what they've decided, and it effectively means the buying entity will get fair market value basis, which in some cases can be a very good answer for taxpayers because if it's amortizable IP, now we're going to have like a pre-tax amortization deduction on a go-forward basis in Ireland in my example. But let's say it's indefinite life IP. If it's indefinite life IP, it's actually a pretty negative answer because as a consequence of being back into the DTL recapture rule that we talked about at the start, you can end up in a position as you start recognizing tax amortization, you actually lose that deferred tax liability, and as a consequence, dilute the effective rate down in Ireland in my example for the transfer. So I think that's the impactful aspect of the guidance from like a transactions or structuring perspective. The big picture takeaway is that we've said on the podcast before that this creates like a separate set of books. This clearly creates a completely separate set of books from what exists today.
Right, which again, I have been saying, I think there have been some naysayers.
I've been a little more skeptical, but I think
and particularly
this is
as
clear.
Trying to build the engine to try to keep track of, like this is an entirely new set of books and things that we're going to have to keep track separately. Like the 5-year DTL was one example, but now we know we're going to have separate books to be able to track the basis for Pillar 2 purposes, book purposes, and tax purposes.
Exactly, and it raises a super interesting question. So to go back to my Germany to Ireland example, US taxpayers are actually going to need to go to like their accounting colleagues and say, hey, what if I had US GAAP basis at the acquiring company? Would you say I get
hypothetical?
Yeah, this completely hypothetical scenario of, well, if I had basis, would I get to amortize it or like what type of IP it is? They're going to get some blank stares, I think, from the accounting people because they're going to be like, well, U.S. common control applies, so we don't have basis from a U.S. GAAP perspective. So it's never something they've had to think about. So I think it's just going to raise a lot more questions as to how we would dig in with the accounting team to actually determine how we treat this like deemed GLOBE basis at the acquiring company on a go-forward basis.
Yeah, it's a great point, Phil, because we've spent a lot of time talking about how important the tax folks and the data that we're going to need to get and the data from the accounting teams. Well, now we're going to need to also have accounting expertise to effectively apply these rules to what I would refer to as kind of hypothetical type
Yeah.
transactions. In other words, transactions that, the people that would typically be doing the entries, we don't really have this as only for globe purposes.
Exactly.
The other takeaway that I have, Phil, I guess maybe two, is that we need to apply different sets of rules for the transition period and then for the full globe rules. And to your point, many, if not most taxpayers are going to be meeting the safe harbor, will rely on the safe harbor, although we continue to hear about taxpayers that are just giving up on the safe harbor and just going to go into the full globe rules. But I think most taxpayers want to take advantage of the transitional safe harbor. If they do so, we need to apply a different set of rules for the transition period than we do for the full globe period. And maybe my last takeaway will be, this is starting to make GILTI feel simple, which it is not. And because GILTI, we had some transition rules as well as we were moving into this, and just the complexity associated with it just keeps getting higher.
And it's just a different world, I think, for most taxpayers too, because I think in the US case with GILTI and Sub-F and all the complexity we've had in the US tax code over the last several decades has prepared US multinationals, I think, more than our non-US parented multinationals. They've never had to deal with stuff like this. Like, they may have a CFC regime, but it applies on a much less common basis than obviously Pillar 2 applies to everybody everywhere.
And without the complexity of the rules, it's typically targeting certain types of passive or similar income. And so I couldn't agree more, and particularly in my global role, have a sympathy for our non-US colleagues that are trying to wrap their heads around this. And I have sympathy for our US colleagues too. I mean, this is complicated for everybody, to be clear, but I think it's a lot more challenging for those that haven't been through the transition to GILTI than those that have. Okay, so let's move on to the next section, which is the allocation of cross-border current taxes. We received blended CFC regime guidance last year for GILTI to tell us kind of how GILTI taxes are allocated. We talked about that on a prior podcast. But this is these rules apply much more broadly and can potentially include other non-US taxes. It felt like that first one was very much targeted to GILTI, which I think it was. What do these new rules say?
So this, I think, to some degree is also somewhat targeted at US multinationals. They effectively talk about certain like cross-crediting or blending regimes. So if you're thinking about a US multinational, I think the most common two will be like general basket subpart F and foreign branch basket income. Because the way that those rules operate is effectively you aggregate up all the income and taxes within that category and kind of blend within the category. And effectively what these rules apply, it's a slightly different approach than what's in the blended CFC guidance for GILTI, but it effectively applies like a four-step approach, which is somewhat similar to the GILTI allocation, that you come up with like an allocation key and this and that as to who gets what. Some of the complexity on it, though, is just they've effectively come out with just a very strict mechanical set of rules as to how these steps are applied. How, for US multinationals, how expense apportionment is taken into account is kind of interesting, how they add it back and how it changes the formula. So I think the big picture takeaway is that there's probably going to be some level of just reasonable methodology taken by taxpayers for allocating these types of taxes that are paid in the head office or in the shareholder under CFC regime. And in the case now, we effectively are bound to explicit guidance where before there may have been some level of flexibility as to what was reasonable for purposes of that allocation. But I think I'm not going to bore the listeners today with details of the four-step approach, but effectively it's just a mechanical approach as to determining how much of that US tax or other parented tax can be allocated down to other constituencies within the group.
Yeah, and I think one of the things that we've learned as part of this process that there are a number of other jurisdictions outside the U.S. that have blended regimes, significantly different than GILTI. But for example, with Japan, and we had Romero on the podcast with Brazil, similar, a blended type regime, full inclusion, but more jurisdictions than just the U.S. that are potentially in play.
Which makes it even that much more complex to try to come up with a methodology that is workable enough that can work across various regimes, which obviously have different rules across the regimes.
The other thing I think that was helpful from the OECD on this was they did provide some nice examples in there and would encourage taxpayers to take a look at those. The examples are always helpful to see.
And pretty thorough. It's like almost 10 examples for both this and the next chapter that we'll get into. So
and it felt a little bit more like what we're seeing from a U.S. regulatory perspective.
Exactly.
Give us the rule and then give us a bunch of examples. And I do find that very helpful as we're trying to process and understand what they mean by those rules.
Agreed.
Okay. So next section is, so in addition to the current tax allocation, we received guidance on the allocation of deferred taxes, specifically, I think, for GILTI deferred taxpayers. Did we get helpful guidance?
So I think generally, yes. So there was a lot of feedback provided to the OECD that there's a subsect of the U.S. multinational population that is doing deferred tax accounting for GILTI. And it's a bit complex as to how the actual deferred accounting works, and they were having a difficult time as to how to allocate anything that's sitting in the deferreds. And basically the guidance just says taxes that are booked, deferred taxes that are booked under a blended CFC regime, i.e. GILTI, are effectively excluded and are simply allocated on a current year basis. So effectively, if you have a deferred benefit or you have a deferred liability, any of the deferred related to GILTI that's working its way through the system is just ignored. And then when it reverses and is recognized on a current basis, it'll be allocated under the guidance they gave us last year.
So what else? There were some other provisions within this. There's some other relevant sections within this provision.
Yeah, so this one I would say, it basically just comes up with, it's a 5-step process instead of the 4-step process that we would have for current tax. The additional complexity here is that there is a limitation kind of baked in for revaluing deferreds down to 15% and what is allocated and kind of all the additional complexity we run into with deferreds. But similar to the current allocation, it's a similar type of methodology of you effectively determine the foreign income and foreign tax, the U.S. income and U.S. tax, come up with a methodology and allocate down proportionally. The benefit of this also is that they provide a 5-year election, actually, because if you open this up and you're like, I don't even know what to do with this, this seems really difficult. If you have taxes that are paid at a head office with respect to a branch or with respect to hybrids or under a CFC regime at the shareholder, you can effectively elect to just not take them into account. So similar to the GILTI deferred accounting, just do everything on a current basis. You could similarly elect for other CFC and head office taxes that are booked.
And again, for both of these, both current and deferred, just very mechanical approaches. But I think
super mechanical.
Super mechanical approaches. All right. So one of the more complex areas of the rules has to do with entity classification and treatment for Pillar 2 purposes. And this is something I've been spending quite a bit of time with, and we've been working through this in detail when assessing structures for our Pillar 2 engine and some of the qualitative aspects of that to be able to determine where do taxes go, who files, et cetera. Does this guidance, Phil, provide helpful insights in this analysis? Tell us a little bit about that.
It does. So I would say out of all the guidance sections that we received in this June package, this is probably the most helpful out of all the sections, because it does really,
so many questions.
It does really just clarify some of the issues with applying the model rules to actual structures in the real world. So there's 7 different kind of issues that they cover within the guidance. I'll hit a few of them that I think are kind of more relevant than others. So one of which is when you're determining whether or not an entity that is a flow-through entity, so think of like a limited partnership that is in its jurisdiction a flow-through entity. So in the country that it's formed, it is flow-through.
So not subject to local corporate or local tax.
Exactly. So like, let's say it's a UKLP is what we're looking at. So we have a flow-through entity, but then there's an additional characterization that's required to determine whether or not that flow-through entity is a tax transparent entity or it's a reverse hybrid entity. And that has to do with effectively testing what the treatment at the owner of that tax transparent entity views it as. So if you would have a partnership that's held by the U.S. directly, the U.S. views it as a partnership, we would say that's a tax transparent entity because it's flow through for both the country that it's set up in as well as the country that it's holders in. The issue with the rules that we were running into is that a lot of the time these things are not held directly by the tax party that actually cares about the classification.
Right.
So let's say instead of having the U.S. hold the UKLP directly, you had the U.S. held LP1 and then LP1 held LP2. There was always a question where you had stacked flow-through entities, whether you could look up through the chain all the way to say, yeah, like all the income is included and taxed up at the next level, it should be viewed as tax transparent, but with how they define the owner of the interest, it just made it difficult. Effectively, what the first issue outlines is you're not bound to the immediate holder if they're also a flow-through entity. So if you have another flow-through entity in the chain, you can effectively keep looking up the chain until you run into an owner that actually has a view as to the tax treatment. So in this case, if we had the back-to-back LPs, we could say both are tax transparent entities, and as a consequence, all the income under the model rules will flow up into the owner at the end of the day. So I think that was very helpful to kind of take away some of the uncertainty where you had intermediate entities within the mix. Within that, it's worth noting that they effectively highlight that if you would have let's say a Cayman or some jurisdiction that does not have a corporate income tax system, you effectively cannot look through at that level. And if they're the owner, you would effectively default back to a reverse hybrid in that case if they don't have a corporate income tax system. So there's a little bit of ambiguity on the general rule of just looking all the way up, but generally I think pretty helpful guidance.
So to maybe pick you mentioned there are 7 specific areas. We're not going to cover all those, but one of the other ones that I think that is interesting is the allocation of cross-border taxes in structures with flow-throughs as we think about the covered taxes that are accrued at the tax transparent at the flow-through entity versus those are at the parent. How does that work?
Yeah, so like generally, like back to the example where you have a tax transparent entity and the income flows up to the owners, the way the model rules work is that generally that tax is going to be booked at the partner because they're the one that's paying the tax. And the Pillar 2 rules operate to effectively align the income with the person that has the tax. So the income goes up to the partner that's paying the tax. So kind of net, we're aligning the taxes and profit. There was a question of, well, there's certain allocation rules that we just went through on the current and deferred. What if we allocate tax down to that tax transparent entity? Does that tax also go up with the income, or does it kind of stay down there orphaned down in the partnership that now no longer has any income? Effectively, the rules provide that that tax that is allocated down can follow the income that was allocated up. So it's helpful in that we still generally follow the principle that the tax that's paid is going to be allocated to the income to which the tax was paid. So if we pay CFC tax on income down below, but the income moves to a different entity, we get to move the tax that's allocated also to that different entity.
All right, and you want to pick a third one?
Third one. We'll do hybrids. So like one of the questions was where if you had multiple hybrid entities, so to go back to the US case, let's say the US owns an entity that's disregarded in country A, and the entity that's disregarded in country A from a US tax perspective owns another disregarded entity in country B. From a US tax perspective, both of those are effectively taxable in the US. There was a question of, well, if the US is paying tax on an indirect basis with respect to that second DRE that's a level down, can we allocate the tax down? Because it generally only provides that in the owner case, you can push it down. The guidance similarly provided helpful guidance that we can take that tax that's paid in the US, and even though it's on an indirect basis, effectively push it down into the lower tier entity that had the income that gave rise to the tax. And it's important that they effectively call out hybrid entities, so think like DREs in the US context, and reverse hybrid entities, where you would effectively still have the income down there because it hasn't been allocated up. In that case, similarly, you could allocate the tax down if it's paid above.
Yeah. And I think many would think that this particular section is very much focused on U.S. multinationals, where we have these various hybrids, which certainly some are. But I mean, it is very common, particularly in fund structures, where we have pass-through entities, as in the financial services industry. So I think U.S. multinationals, as well as non-U.S. based multinationals that have pass-throughs, really need to spend some time with these rules to understand exactly kind of the mechanics. And maybe, to kind of round things out here, Phil, what do you, this is, again, we mentioned a very mechanical set of rules, which frankly, as an advisor, is something that I welcome. Tell me how the rules work. It helps me advise. I think taxpayers would say the thing, and it'll help us comply with these rules. What is your view on future expectation of guidance? Because you mentioned earlier in the podcast that some taxpayers and commentators have been out there saying, and even governments have been saying, we need to slow down. We have to process, understand before we can enact. I mean, there's 36 countries that have to potentially deal with this new administrative guidance. Are we going to continue to get this type of mechanical administrative guidance? Will they slow them down? Will they slow down? There's been some recent public comments about what we could expect from future guidance, but what is your view on that?
So earlier this calendar year, before a lot of this noise on the pause and guidance came out, it was the original intention for them to come up with 3 additional admin guidance packages this year. I think most are thinking with kind of the political situation with people pushing back on the timing, I think we generally expect 1 more admin guidance package this year, most likely with the December timing at the end of the calendar year. But the general idea is that there's a variety of things that are meant to be covered in that. Some of it is like very specific, unique questions for like airline industries or ESOPs or like these very kind of fact-specific questions. The bigger topics that are going to be broadly applicable to most, one is the incorporation of the anti-arbitrage or hybrids guidance from the December admin guidance package last year. That December admin guidance package last year only applies today for purposes of the CBCR transitional safe harbor. But in that document, they explicitly say, we're going to take some of this and incorporate it into the full rules. So as we understand, the OECD Secretary and the Working Party are working through how they can do that. They're trying to do it in hopefully a little bit more narrow of a way than what we got in December of last year, but I think we could expect that most likely in this package we'll get in December. Similarly, there's been a lot of focus on Chapter 6 of the model rules, which has to do with like acquisitions, divestitures, how some of those things are taken into account, or just transfers of assets between groups when you're within the Pillar 2 rules. There's this special rule for like a globe reorg, which as drafted in the model rules is really hard to qualify for, if not maybe impossible to qualify for.
Need some guidance on that.
If you're reading it very strictly. So I think those kind of things, they're trying to come up with guidance that may make the globe reorg rule a little bit more accessible, but in other areas put out guidance that maybe will be tackling what they would be viewing as more abusive type transactions in the acquisition divestiture space. So I think those are probably two areas, albeit I've stopped trying to predict what exactly the OECD is going to put out.
Same.
So.
But again, and I think any of this guidance would be helpful. The challenge is going to be how do enacting jurisdictions actually bring this into their law? Yep. Are they able to do that kind of retroactively back to the beginning of the year, particularly if this stuff's coming out in December? I think constitutionally, many of the jurisdictions may struggle with that. So it's one thing for the OECD to put out the guidance, including this guidance, and then the real question, and we'll continue to keep an eye on things, is how does that administrative guidance actually get into these 36 countries' laws?
Because most countries have, for tax measures, usually either a budget bill or a finance bill that is the carrier pigeon for these, and that usually only happens once a year. Right. So if you have guidance that comes out at the end of 2023, there's just no way it's going to be what year are we in now? 2024? The end of 2024. It's not going to be enacted until sometime in 2025 because there's just not that immediate mechanism to incorporate the guidance.
Well, as those jurisdictions enact those rules, you'll hear about it here on the Cross-Border Tax Talk. So thank you very much, Phil. Always a great discussion, and look forward to future administrative guidance and other Pillar 2 developments and having you back.
Awesome. Thanks for having me.
So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Phil Ramstetter, PwC's International Tax Services Partner. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.